Hey everyone, today we witness a landmark event in the financial landscape, both on the ASX and the NASDAQ composite, where they've surged to uncharted territory, reaching all-time highs. It's exciting stuff. So today we're going to quickly dissect the technical implications and the underlying forces behind this momentous occasion. For the uninitiated, an all-time high signifies the highest closing price an index has ever recorded. This milestone reflects a period of sustained upward momentum characterized by bullish sentiment and robust market performance. In simpler terms, the ASX breaching new all-time highs indicates the collective market cap of the top 200 Aussie companies has never been greater. And in similar fashion, the NASDAQ's ascent to record levels signifies the combined market value of the prominent US tech giants has reached unprecedented heights. Now, these record highs carry weight beyond mere headlines. Here's a deeper look at their technical and economic implications. Firstly, there's investor confidence. This is what drives markets, so it's kind of a biggie. This recent kick upwards signifies a resurgence of investor confidence in the underlying fundamentals and growth potential of companies within these respected markets. Now, this translates to increased investment inflows, potentially fueling further economic activity as investors jump back in for fear of missing out. They don't want to miss the run. Secondly, from a technical standpoint, the ascent to all-time highs could be interpreted as a confirmation of bullish continuation patterns. These patterns, identified through technical indicators and chart analysis, suggest the upward trend has a higher probability of continuing in the near to medium term. However, it's crucial to remember that technical analysis is not foolproof and doesn't give you a crystal ball to peer into the future. There are times where market movers can and will deviate from these established patterns. Thirdly, economic growth. Historically, strong market performance has often corresponded with periods of economic expansion. As companies experience higher valuations, they're incentivized to expand their operations, hire new employees, and contribute to overall economic growth. However, it's important to acknowledge that the relationship between stock market performance and economic growth is complex and not always linear. So what's driving the rally this time around? How can the market be going up when there's still plenty of doom and gloom in almost everything you read? Well, there are several key factors that are propelling this particular market rally. First, there's the stellar earnings season that we've recently had. Many companies, particularly in Australia, have reported impressive earnings, surpassing analysts' expectations. This positive earnings surprise has bolstered investor confidence and fueled the upward momentum. Now, don't get me wrong, there have been some shockers too, and their stocks have been punished because of it. But overall, it's pretty good, with some silver linings appearing from the clouds of the past couple of years. Another factor, of course, is the moderating of inflation, which is a sigh of relief for so many investors. The recent signs of inflationary pressures easing in major economies like the US have alleviated concerns about central banks raising interest rates further. As we know, rising interest rates can negatively impact stock prices, so their potential moderation has been met with positive sentiment from investors. There's also been the tech sector bonanza that we talked about in other videos like the Nvidia one just recently. Innovation breeds growth. The ongoing boom in the technology sector, particularly in the US, is acting as a significant driver for the NASDAQ's ascent. Technological advancements and innovation continue to fuel growth within these companies, attracting investor interest and pushing valuations higher. It's a race to the top for those who can innovate fast enough to stay ahead of the game in today's ever-advancing landscape, and it's a hard crash to the bottom for those that fail to keep up. Now, before we finish up, let me just share a word of warning to you. While these record highs are undoubtedly a positive development for the markets, it's crucial to maintain a healthy dose of caution. The stock market remains volatile, and periods of correction can often follow periods of significant upward movement like we've seen. Therefore, thorough research, sound risk management, and a detailed plan with strict rules of how you'll approach the market at all times is essential before making any investment decisions. So if you'd like to learn how to get your head in the game and easily manage your emotions in whatever the market throws at you, please feel free to download our ebook, From Flustered to Unflappable Trading by Gary Stone, down in the description. And while you're down there, don't forget to like and subscribe for all the latest market insights with a little bit of fun thrown in for good measure. Thanks for joining me today on this exploration of the technical and economic implications of the recent market surge. Remember, this video is for education purposes only and shouldn't be taken as advice to buy, hold, or sell any particular instrument in the market, and that past performance is not an indication of future performance. Until next time, where we look at the markets again, enjoy the ride, stay objective, and stick to your plan. Bye for now.